All right, everybody. It started today. So it's not a theory anymore. It did start today. A lot of investors have been watching the Nasdaq, but smart money has just pulled the trigger on something, a $10 trillion wealth shift that's going to catch a lot of you guys off guard. So if your portfolio is still 100% heavy in tech, you're not just holding, you're sitting in the middle of a massive sector shift. And we're starting to see pretty fast rotation into sectors such as value and small caps. It's happening in a pretty big way. The question is whether it's going to stick or not. And so, as you stick with me through this video, we're going to show you by the end where that money is rotating towards and how I've positioned to be able to take advantage of that going into 2026 with hopes to grow this portfolio and at least beat, if not outperform or pace the market in 2026. Stick with me. Let's jump in.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
Back, guys. So there are some big moves happening in my portfolio. Let's get really real here for a real second. So today, for a second day, my portfolio is up about 1%, at times more than 1%. Yesterday it was also up 1%. And you can just see that motion that you get when you have, in my case, admittedly, a smaller six-figure portfolio. But the last video I did, I think, was 2 days ago. I was sitting at 117,000 something. So $2,500 in 2 days, just for sitting on my butt and having made smart decisions, having sacrificed for several years and parked my money wisely. So there are some changes going on in the market. Let's go ahead and let's look at the gains today. One of the other things we're going to talk about by the end of the video is we're going to discuss, is it worth investing if you can't routinely beat the market? So actually, let me jump to that really fast. This is not. It's a third subject is it's good to track your own investments, right? And so this shows this is an older iteration of my portfolio that's about 2.5 years old. And when you divide that number by 2.5, it's something like 16%. This is another iteration of my portfolio that's closer to what I have today, but it shows about 16%. And then this portfolio here, it's now showing sort of some accurate information. Over the last year, the market went up about 17%, and I believe my portfolio went up at this point about 14%. So you can just kind of see right there, 16-ish, 14-ish. So the blue line is my portfolio. You can see that it's been tracking the market nicely, and there, even for 2/3 of this chart, I had outperformance, and I'm getting some velocity here. So the third question or second question is it worth it to actively pick stocks if you can't beat the market? Surprisingly, I think that my answer is yes, and I have a reason for that. We'll touch on that as we wind down the video, but let's get back to the main premise of the video and take a look at what's going on today. Let's go ahead and compare and contrast my current portfolio versus the S&P 500. And it looks like I'm now just starting to pull away in the last month. So that's showing December and the first couple of days of January here. But today, Uber's going crazy. They just announced a partnership at CES, the electronic and technology trade show in Las Vegas, with one of the EV providers, Lucid, I think it was. So they're going to roll out 20,000 luxury SUVs. Amazon, now, this is also part of the theme of the video with market rotations. So out of the Mag 7, Amazon was like the second worst performing of 2025. Oftentimes, there's something called a January effect. And so you don't necessarily just want to buy the hottest stock. We're going to switch back over here and we'll come back to this. You don't want to just buy the hottest stock of the year. So this is FinViz. This is a really great resource. We can essentially see 2025 by going to FinViz on their maps and looking at what did good for the last year. So the best places to be last year were in a few different areas, right? but last year you wanted to be in chips. If you were in the SMH, you probably would have had about a 40% gain. So you wanted to be in chips last year. Broadly, technology last year was a good place to be. Even owning the index or a more specific sector index, Palantir did a lot of heavy lifting. It went from a smaller stock to an influential stock. Apple's going to be in those different areas. Amazon didn't do as good last year compared to Microsoft at 14. Amazon was, quote, only 10 versus 65% in Google. That's where you wanted to be. Another couple of good places to be would have been specifically in JP Morgan or in bank stocks or financials. But it really mattered which stock you were in. I own Visa. That was up 14%. JP Morgan was up 40%. So if you own the index, your performance actually was probably closer to Visa, which I just owned. So I had less upside with more risk in a single stock name. So it's just interesting how that works out. And then Eli Lilly was big, and that's for the last 12 months. But across that sector, United Healthcare was a big drag, which is actually the biggest holding within the entire healthcare sector, whereas that's a drug manufacturer. So it's all just very interesting. Consumer, you wouldn't want to have been in Procter and Gamble, but if you're in Walmart, you're up 27%. So that's the last 365 days. Now let's switch and see what the winners are for 2026. Okay, we're gonna go year to date. How it has changed. So just dark red, murky. So semiconductor equipment and materials. So this is like the AI build out rotating or broadening. That seems possibly positive. Okay. Now you've got some other stuff that's going on though. Microsoft did so much better than Amazon last year. Now here's Amazon. A lot of this just being today, right? And so you also see some different things going on. So whereas this healthcare drug manufacturers did really good in 25, now it's just a few days. It doesn't make a trend. But that January effect is people are going to rotate over. So now you have UNH up 6.3%, which leads that whole market, so on and so forth, right? And so some winners continue to win, like Walmart, but you can see just where things start to rotate. So let's look and see what Micron Technology did in 25, and then let's also see how this equipment and materials did in 25, because they're bright green, the brightest green areas of the map here of note. So let's go ahead and switch that back and just see if we can see that January effect in motion. Nope, they were they were hot in 25 as well. So the more that you know. Let's go back here, guys. So just taking a look at this portfolio. Oftentimes winners are going to win. They're going to continue to win and run, but you want to be aware of that January effect. Now, I promise you, we would talk about one other subject, which is it worth it? And it's hard because of the tracking, but I've been invested since early 21. I'm probably annualizing something around 11%. That included a nasty 2022 where I had relative outperformance, which means I went down less, reinvesting dividends, things that nature. So probably 11%, which is pretty dang good. It's better than average. It's probably in the 51st percentile of fund managers. And so why is that good when I would have had higher returns with S&P 500? Part of it's to make myself feel good, but also I think that people who index are more likely to just be focusing on retirement funds, where I want to make money for myself before I'm 65, where I can really enjoy it. And so if stock picking and trying to do these things brings you more knowledge and information and excitement about the market, it gives you confidence to be in the market. Even if you ultimately end up becoming an indexer or a closet indexer, that's worth it, because no matter what I do from today forward, if I hold on to this principle, it's going to balloon up to about $2.5 million by the time I retire. So I've already won.